You're listening to Across the Table, a healthcare private equity podcast brought to you by McGuire Woods. Across the Table brings you inside the conversation with the specialists and professionals of the healthcare private equity industry.
Hello, everyone. This is Geoff Cockrell from McGuire Woods, and we're bringing you another installment of our Across the Table series, where we have conversations with deal makers in healthcare private equity, talking about sectors, trends, and all the things that drive transactions in healthcare. I'm super thrilled to be joined by my good friend Paul Barrett from Argosy Healthcare Partners, which is a subsidiary fund within Argosy Capital. Paul, tell us a little bit about yourself and what you're building at Argosy.
Absolutely. Thanks, Geoff. Grateful to be here with you today. So appreciate the invite and excited to discuss. Yep. So Paul Barrett, originally from the Philly area, and spent the last 14 years in greater New York City area, all in healthcare-related ventures. For the last 8 years, was a partner at a lower middle market dedicated healthcare firm. More recently, and in my current firm and partnership with Argosy Capital, returned to the hometown with my family and launched a new vertical and a new standalone firm and team within the Argosy Capital family of funds. They're located in Wayne, Pennsylvania, which is suburban Philly, and have 5 distinct lower middle market focused strategies. First, the generalist PE firm, focused on manufacturing services and business services, real estate, credit, secondary, and most recently, obviously, healthcare that we launched January 1 of this year. And Argosy was founded over 30 years ago, in 1990, and has stuck to their kind of core values and principles throughout the way. Which are about partnership and focusing on small and medium-sized companies. So we're thrilled to be, 7 months in. And lastly, the core part of our strategy is majority control transactions in supporting lower middle market, founder-owned healthcare services companies.
Paul, as you look at the market, looking at targets that you find interesting, what segment of the market from a size perspective do you focus on?
So we focus on the small stuff, and that's a key part of our kind of thesis and strategy, and trying to differentiate ourselves in a super competitive market. One, obviously being sector focused, 2, majority controlled deals exclusively, and then 3, founder owned, and we'll go anywhere in the U.S. But then we try to go to the most attractive healthcare services end markets, but find direct or a little less competitive opportunities by just going subscale. The kind of tandem component of that strategy is that we have a bias towards buy and build. So fragmented areas like post-acute care services, home health, hospice, staffing, a lot of the provider areas obviously lend themselves to that as well. Revenue cycle related services. We actually have a product and distribution business under LOI right now, which is going to be a buy and build. So great healthcare services market, founder owned and led, and we really like to back founders and support them in executing their vision, and bring capital and outsource M&A expertise and support services to the table, and then let it rip together.
So you focus on companies that have EBITDA in the $1 to $3 million range. Why do you think that is the attractive part of the market for what you're trying to do?
I mean, a lot of it is the competitive aspect of things. Obviously, when you get to 10 million in EBITDA and above, each kind of range has its own category and step up in competition and multiple expectations and also formality of the process. And as everything keeps getting more and more competitive every year, even the thresholds are seeming to be lower. It used to be 10 million of EBITDA was when you hit a kind of game-changing point of competition. Then it was 5, and there's even an argument for 3 now because of all the activity in the lower middle market and the middle market funds dipping down and probably deploying a similar strategy. And it really is, once you plant a flag, then your ability to source add-on acquisitions and bring talented executives that are looking for, medium and bigger size company opportunities. It's planting that flag is a game changer in an end market when you have a 5 to 7 year window like we do, in terms of accelerating your pace once you're in. So it's really super important for us to find the right business and quality of the founder that we're teaming up with, but And even we say 1 to 3, and our range is really 1 to 2. That's where we find ourselves, finding direct opportunities and situations where we can take our time and we can do a lot of upfront due diligence. We can build a personal relationship with the founder, and then they're either looking for capital to execute add-on acquisitions, or they want to clean up their cap table, or they're just ready to grow a little more quickly, and doing it as one individual is tougher.
I think that's a great strategy, and I especially in sectors where kind of finding platforms is a real challenge, which obviously contributes to the pricing difficulty that you talk about. But it also kind of avoids a problem that we encounter with some other funds of if they need it to be $6-7 million of EBITDA, they will at times be cobbling together things that were smaller to begin with. And I think your strategy of just focusing on getting, like you said, planting that flag is a great strategy. When you're kind of starting at that part of the market, what are some of the challenges that you encounter with those platforms?
Yeah, I appreciate that, because it's all, you have choices. It's an imperfect world, so you have to just kind of pick your lane, and it'll have the kind of aspects that you're comfortable with. I mean, kind of personally, from just an approach perspective, I like having, and our team, likes having more time and a more direct approach and the chance to build personal relationships and that type of thing. But with that comes a lot less infrastructure, a lot less professionalism, and certainly being in the weeds in order to support these businesses, particularly for that first year or two. There are times where we're able to find a little more down the runway business or a sophisticated founder, like this business that we have under LOI in the distribution space. He's, a super sophisticated guy, but at this lower end of the market, that's a little bit more the exception than the norm. So we elect to have, more time and a more direct approach and be in the weeds. But the trade-off is that it certainly has its challenges in terms of getting the businesses up and running, what they're able to do on their own, what we have to be intimately involved in out of the gate and for the foreseeable future. And obviously with that comes some risk, but in weighing all the factors, we just like that area. 3 million of EBITDA now is things are even more competitive there, or 5. I mean, we just like our chances to get to that platform stage in a reasonably accelerated way by just putting together a couple of the small businesses that are being completely overlooked.
Once you've kind of planted your flag and build add-ons, when do you usually think about selling to the next buyer?
We hope, if we're fortunate, the 10 million mark of EBITDA is a bit of a magic number in the sense that once we achieve that range or are even getting close to that, I think, again, if we're able to pull that off, if we're starting in the 1 to 3 zone and we're approaching 10 or at 10, we're in a very positive position and situation. So that's the time where, we'll probably evaluate it on a quarter or half year basis. We do have the family office capital and kind of history with all the Argosy related vehicles. So there isn't pressure at this evolution of our firm because we're pre-fund. We're leveraging the family office balance sheet to do deals. So we're not on a fixed timeline. So if we have a fantastic team and, everyone thinks that we could get to 15 or 18 or even 20, versus selling at 10. So once we get into the high single digit and approaching 10, then it's kind of case by case basis, I guess, and being reevaluated.
Part of the market that you focus, I would assume that for every $7 to $10 million EBITDA company, there might be 30 that are in the $1 to $3 million EBITDA range. How do you think about deal sourcing in those dynamics? And because on the big end, you've got things are much more scarce, but you've got bankers and other folks that are kind of involved in the deal sourcing for the buyers. How do you think about the smaller end of the market from a deal sourcing perspective?
Yeah, there are tons of businesses in that size range. So, I mean, for us, we just keep getting, somewhat narrower and narrower in terms of what we're focusing on. So both the end markets and kind of the businesses themselves. But I think at the end of the day, and this has been more crystallized in this first 8 months, because there are a ton of healthcare services, 1 million of EBITDA businesses out there, but there's not a ton. There's, a much smaller number that fit the bill of a platform, at least from our perspective. And they're this is not what probably most firms would view as a platform with a 5 to 7 person executive team, all systems consolidated and pedigreed and the track record and done add-ons. Like for us, our expectations are different, but still more so than a retiring founder with a home health services agency with $1 million of EBITDA. Like that, we can't start there. And really, the preference is for a younger founder that's really looking for a partner. So those are a little bit more few and far between.
As you're looking at the market in sourcing those deals, how much do you lean into the independent sponsor world? They serve a significant function in sourcing some of those harder to find smaller deals. Is that an area where you spend a lot of time?
We have, and particularly through your network, which we're appreciative of, and it's certainly a growing end of the market. I guess right now where we are in our evolution, we are functioning, we have the committed family office capital, but we're pre-fund. So, and the way that we're structuring our deals is more of a traditional fund structure versus an indie sponsor structure. But at the same time, we're functioning in that role a bit. So we're kind of leaning on the legacy BD and origination tools and strategies that we use in my former firm, which is a ton of broker outreach. And for us, the sweet spot is a little bit more of the independent brokers and the groups that have, a couple deals a year or, certainly outside of the kind of middle market M&A world. So, for us, it's specificity of end markets and sectors, the 5 or 8 that we're focused on, being in constant communication with brokers and intermediaries. We also try to go direct. We leverage technology tools, whether it's Source Scrub and even our CRM system to attempt to go direct to some founders to try to drum up opportunities in areas like healthcare staffing where we have a really specific thesis. And then now things are opening up a little bit. I look forward to heading to McGuire Woods related conferences and others to kind of and we do a lot of healthcare industry conference stuff to try to get embedded and build direct relationships, always with the goal, if we can, which is a longer term sales cycle. But what we did with Naviderm, which was, build a relationship with an executive recruiter and really pitch something unique. It took over a year, but those were total direct introductions to founders that, we were able to do outside of intermediaries.
You mentioned that looking at kind of the end market buyers of platforms, you've landed on 4 or 5 kind of subsectors in healthcare that are of particular interest to you. Can you pick 1 or 2 of those and kind of talk through what your thesis is or how those end markets have kind of narrowed the field of possible sectors to invest in to these handful?
Yeah, absolutely. Healthcare staffing is a really interesting world right now. So I'll give a quick past history. My former group, we teamed up with 2 founders in Edmond, Oklahoma, a business called AHS Staffing. They're focused on 2 niche areas of the temporary healthcare staffing world, dialysis, travel nursing, and pharmacy. Mark was a serial entrepreneur. He had previously built another healthcare staffing business that he sold to CHG Healthcare, which is the 2nd largest healthcare staffing business in the country. So he had great background. They're 2 really, really good people, him and his co-founder. So that was a little bit of what we're looking for. We think this was 2016. We thought the tailwinds in the sector were great, super fragmented. And our thesis was, all right, there's tons of founder-owned businesses out there in our strike zone, 1 to 2 of EBITDA, focus on one area of the market. Let's all come together, build a consolidated corporate back office, inject technology. And then, we'll have a diversified platform like AMN Healthcare, which was the behemoth in the sector, remains the behemoth, publicly traded, that type of thing. So we did 5 deals in 12 months, injected a lot of technology. One of the add-ons was a SaaS business, and we put a bunch of capital into that. And fast forward, the business has done fantastic. The COVID tailwinds, helped more recently in the travel nursing segment, but we're looking to replicate that strategy and thesis. It might look a little bit different, but we're looking to team up with founder-owned temporary healthcare staffing business with 1 to 2 of EBITDA as a platform to start, with a great owner-operator that wants to go on the ride and the journey of, executing a buy and build and getting bigger and that type of thing. So, and then lastly, the healthcare staffing market, because of COVID, is dynamic and also a little bit difficult to peg right now. The travel nursing businesses doubled all last year. So there are dozens and dozens of those in the market, obviously, trying to cash in a bit because would be tough to be higher than where they are now. And then there's the locum tenens, the temporary doctor-related businesses, which a lot of them struggle because elective procedures were down in ERs and hospitals and health systems. So a little bit of winners and losers, and tough to predict the next 12 to 24 months, particularly if COVID stays choppy. So we'll see.
On the provider services side, on the physician side, what sectors do you find interesting or that you have a thesis surrounding?
We've been putting the provider services a little bit on the back burner, candidly, and been focusing on a little bit of post-acute care services with, home health and hospice in terms of direct kind of provider-based companies. Obviously, we work together in the dermatology services space, which I still think has a lot of opportunity. And, the areas that we are looking at a bit, but candidly, it's a little secondary, are derm, dental, and vet, which are probably the three hottest areas. So nothing terribly special about the thesis there.
But areas where if you could buy something small, build it up a little bit, there'd be a lot of buyers for those. Still make sense as well. On the post-acute side, taking home health and hospice, we have seen a significant uptick in deal activity in those sectors. So what's your thought process around your thesis for those particular sectors?
Yeah, that end market, as you mentioned, the outlook's really good in terms of aging baby boomers and all the healthcare services trends, personal patient preference to be able to be in the home, and also the cost of care and all that type of thing, which has been the long-term trend for a while. And it really lends itself well to our model of starting small and then executing a buy and build. At the former firm, there was a business called Care Advantage, which was a mid-Atlantic provider of private duty and personal care services, teamed up with a founder-owned business, about $2 million and change of EBITDA, executed, I think, 12 or 13 add-ons in a 3-year period. It's a fantastic team, business, geographic density, and, it was just a great outcome. And I think that strategy is just very replicatable, whether it's the skilled Medicare services or the private duty stuff. Starting in pick a geography. We're outside Philadelphia and Pennsylvania, so East Coast ideally, but, it could be anywhere. $1 million of EBITDA, younger founder owner operator that has the capability of and interest in becoming the platform, roll 30-40% of equity, and then execute the buy and build. So we're excited about that one.
Paul, you also mentioned that you have a thesis surrounding Pharma Services, another area where we're seeing a ton of interest, and it has some benefits of being less susceptible to direct government reimbursement and all the risks that come with that. But what's your thesis around Pharma Services?
Yeah, the greater Philly area of Pennsylvania is a great life sciences and biotech services market, so we're trying to lean into the local relationships as well. But we have two theses in this end market. One is on more of the consulting Pharma Services related side. So the trends in this end market are increased outsourcing by small, medium, big pharma and biotech businesses. And that's everything on the commercialization side. It's everything on the medical affairs, compliance, regulatory, all that whole host of outsourced services. There are a ton of 5 to 15 to 18 million revenue businesses, oftentimes focused on their local geography of pharma businesses, whether it's San Diego or Boston or Philly, that have nice base businesses. So we'd love to consolidate that market, similar to healthcare staffing in a way where there's founders focused on one area. So bring them together, consolidate the back office, cross-sell services, diversify the customer base, diversify geography. So that's on the Pharma Services side. And then on the life sciences tools side, so, the reagents and components that go into the drug development process, love that side of the world. It's, everything related to cell and gene therapy is in hyper growth mode. There's tons of big strategics that are highly acquisitive. So whether it's cells, tissues, proteins that are being designed into the drug development process or sold into academia, those are two super interesting areas for us.
Maybe switching to kind of macroeconomics, given your part of the market that you're looking, how impacted do you think your part of the market would be from either a little bit of a downtick in macroeconomic activity or a little bit of uptick in interest rates? when you think about the high-end market on size, those little adjustments can have a significant impact on multiples at that size and significantly change some of the business strategies. In your part of the market, does it work the same way, or are they a little less impacted from a pricing perspective on some of those macro trends?
Yeah, we hope to be a little bit more insulated just by the fact of, one, obviously being in healthcare, two, just the size of the deals that we're doing. They're always going to be lightly levered, one, because we take a conservative approach, but two, they just don't have the sufficient cash flow to support a lot of debt. So, and I think it's also evidenced by, for the last many, many years, and it's still true today, we essentially are acquiring all these businesses for between 5 and 7 times, sometimes a little bit more. But that hasn't changed over a pretty long period of time. And for us, again, since this is the small stuff, in a hotter market, maybe it's 7.5 times versus 6.5 times, but that's on $1 million of EBITDA. So this is like overall, it's a pretty narrow band of things versus the big guys that are acquiring 20, 30, 40 million EBITDA businesses, and the leverage that's involved in that and the pricing, and it's just much larger enterprises versus what we're doing.
There's a lot of reasons why I think your part of the market is a great one to be building in, for kind of the insulation from competition, insulation from economics, a ready supply of upmarket buyers. Why do you think there are fewer folks kind of at your end of the market? I think it's a great strategy, but you're a little bit more unique. Why do you think that is?
The evolution of funds typically takes you more upmarket, because if you're able to invest in larger, more concentrated deals, one, you can leverage your team, more effectively in that way. And two, you can raise more capital. So I think we're going to be a little bit, as we hopefully evolve, if we're fortunate enough, higher volume in our same strategy. And if you're putting out 100 million equity versus our 10 million, you can obviously build a bigger platform and kind of institution. And I know that, people often talk about people continuing to move up market, and it makes sense. They want to do bigger deals so they can have bigger platforms and that type of thing. So I think people naturally kind of evolve in that way, but we found the area that we like. So we, plan to stick to that.
Paul, I think your strategy is a tremendous one, and one that will be successful for a long time, given those dynamics. Whether we're talking about an investment banker or a business owner, how can people find you?
Yeah, I really appreciate that, Geoff. And we welcome any and all intros. They're all valuable to us. Intermediaries, bankers, healthcare executives, board members, people just looking to connect. Please email me, P Barrett, 2 R's, 2 T's at argosyhp.com. I'd love to connect and team up on a sector, or, find ways to be mutually supportive.
Thanks a lot, Paul. I think we'll call that a wrap, and we'll see everybody on our next installment.
We appreciate you joining us on this episode of Across the Table. To learn more about today's discussion or to contact us, please visit our website at mcguirewoods.com. We look forward to hearing from you. This podcast was recorded and is being made available by McGuire Woods for informational purposes only. By accessing this podcast, you acknowledge that McGuire Woods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in the podcast. The views, information, or opinions expressed during this podcast series are solely those of the individuals involved and do not necessarily reflect those of McGuire Woods. This podcast should not be used as a substitute for competent legal advice from a licensed professional attorney in your state, and should not be construed as an offer to make or consider any investment or course of action.